Let's take a look at preparing another statement of stockholders' equity. Carl Corporation designs and produces a line of golf equipment and golf apparel. Carl has 150,000 shares of common stock outstanding as of the beginning of the year. Carl has the following transactions affecting stockholders' equity during the year. On March 1st, issues 60,000 additional shares of $1 par value common stock for $50 per share. On May 10th, purchases 10,000 shares of treasury stock for $58 per share. On June 1st, declares a cash dividend of $1 per share to all stockholders of record on June 15th. On July 1st, pays the cash dividend declared on June 1st. On October 21st, resells 5,000 shares of treasury stock purchased on May 10th for $62 per share. Carl Corporation has the following beginning balances in its stockholders' equity accounts on January 1st. Common stock, $150,000. Paid-in capital, $6,750,000. And retained earnings, $2 million. Next, net income for the year ended December 31st is $500,000. Taking into consideration all the above transactions, prepare the statement of stockholders' equity for Carl Corporation as of December 31st. So let's go ahead and look through this. On March 1st, Carl Corporation issues 60,000 shares of $1 par value common stock for $50 per share. What that's going to look like is a debit to cash for the total amount. The common stock will increase by 60,000 and the additional paid-in capital will increase by the remaining amount. So, on the statement of stockholders' equity, the common stock will have 60,000 additional dollars underneath its column, and additional paid-in capital will have $2,940,000 under its column. On May 10th, they purchased 10,000 shares of treasury stock for $58 per share. So you're going to recognize treasury stock in cash when you're doing the journal entry. On the statement of stockholders' equity, you're going to see the purchase of treasury stock under the treasury stock column as a negative number because it's a contra equity account. Net income for the year ended December 31st is $500,000. Down there, under retained earnings, you'll see net income for $500,000. On June 1st, they declared cash dividend of $1 per share to all stockholders on record on June 15th. Remember, dividends are not paid on treasury stock. And on July 1st, they're going to pay that cash dividend declared on June 1st. So the cash dividend is going to be equal to 200,000 shares. How did I get that? I'm looking at common stock here, okay? And under common stock, we have 150,000 and 60,000, both of those at par value. That brings us to 200,000 minus the 10,000 shares of treasury stock that were sold. So take the 200 shares times $1 per share, and that's $200,000 in cash dividends. So dividends can be 200,000 and dividends payable will be credited by 200,000. When it's paid, dividends payable will be cleared out and cash will be reduced by 200,000. On the statement of stockholders' equity, the cash dividends will be listed under retained earnings as a negative number. On October 21st, they resell 5,000 shares of treasury stock that was purchased on May 10th for $62 per share. So more than they originally purchased it at. So you're going to recognize the cash for the full amount. Now the treasury stock, however, you're going to recognize those 5,000 shares times $58 per share that you originally purchased it at. The additional paid-in capital will be for the difference. So you'll see treasury stock at $290, an additional paid-in capital of $20,000. Next, you'll total up all the columns, and that will give you the statement of stockholders' equity.